Hi, a good afternoon to everyone. And many thanks to IFAS again for inviting Principal to this very interesting, what I call speed dating for investments. I've got about 20 minutes, if I recall, to basically just share with you my thoughts on the markets, particularly on equities itself. And our theme for this year itself, especially in the first half, is to just backtrack a little bit and think about growth from a more sustainable basis, not just from an ESG point of view, which one of the previous speaker was alluding to early on, but more importantly from an investment return point of view, as well as from a growth perspective, right? As you all know, essentially, the markets itself, right? And you can see here in this chart, over the last 2 years have had a very fantastic run, right? Especially in developed markets, whether it's going to be the US, whether it's going to be Europe and Japan as well, right? And you can see that NMCI World up by 20% last year and 40%. Most of this, as you probably remember from the other speakers as well, they probably alluded to the fact that a lot of this is being fast forwarded mainly because of what we call quantitative easing, which means in non-technical terms, it means the fuel engine that fuels the markets. And sometimes I think, right, we forget that this jet fuel engine has to come at a price. And the price of this is the price of money, interest rates, which I will talk about a little bit later on how we see the trajectory of the US Federal Reserve interest rates, how it will impact developed markets as well as Asia, but more importantly, from your point of view, how it would then shape the way you think about your ability to diversify away from all of this noise and think about more sustainable returns going into 2022. And I think this is going to be a year, as I told my team this year from January the 2nd when I first came back to work, it's going to be a year where it is really going to be, pardon the pun, where investors are going to be either men or boys. And I'm not trying to be sexist about this. Essentially, what I really mean is that, you really need to be able to navigate across the volatility and all these kind of noises that we're hearing, oil prices going up, tapering, and all these technical jargons and so forth. But I do think that if you look at this particular summary of the returns, I do think that those which are in double-digit returns will moderate. And I think the sustainable returns will come from the markets which have underperformed, particularly, for example, like China, for example, and certain markets in Asia, which we continue to be very, very positive on, going especially in the first half of this year. The other point I want to talk about as well, if you look at the bottom half down here, is that don't forget at the end of the day that despite the fact that from an asset allocation basis, we continue to favor equities versus fixed income, you need to also be risk aware and more importantly, think about yielding assets as well, where you can see down there, the fixed income market, obviously because of interest rates have been rising, have been in negative returns last year. And I do think that in the first half of this year, it will continue the trend. But I think at some point in the second half itself, yields being backing up where it should be, especially in the 10 years in the US Treasuries, where I think it will be hovering between 2 to 2.2% at some point. I do think it will set itself up for some opportunities in fixed income as well. The point I'm trying to make here is that essentially, this year itself is not going to be a very, very straightforward year. I do think that it's going to be also a very exciting year for us to think about. So what is going to perform and outperform? So you can see here a bit of marketing down here, things that have performed last year, mainly developed markets, our Global Titan Fund, Millennial Fund, most of the global tech have done fairly well. Asia itself, more subdued returns. For example, our flagship fund, Dynamic Income Fund was up by 2.8%. But of late itself, you can see the China markets as well as Asia starting to so-called decouple away from the noise from the US. I'll talk a bit about later. And also sometimes people also forget nearer to home itself, we've got ASEAN, we've got China. These are markets where I'm very, very excited about. And I'll talk a bit about later. And on Malaysia itself, despite all the volatility we've seen, and so forth, I think we are going to see potentially a more subdued returns in Malaysia. Having said that, small caps opportunities will still abound. So I think that trend will continue in 2022. But more importantly, before we get into what are the opportunities are, I thought it'd be good to set up the framework on how we think about growth from our point of view. This is a summary of our compilation in principle. whereby we can see down here, the average return for average growth rate for US will be about 3.7%, where it's going to be front-end loaded. We can see here Q1, Q2, high 4s to mid 4%, and moderating to 2022. This has implications to our outlook on inflation, and this has implications to our outlook on interest rates. Effectively, our base case is that the US Federal Reserve will raise rates by at least 3 times this year and another 3 times next year. But that's assuming that inflation continues to be on the rise, which we think in the second half of this year, it will start to moderate a little bit. Now, when you think about the other markets as well, like China, for example, we think that we are now entering an environment as well, which I'll talk a bit later, where I think there is going to be a decoupling in terms of monetary policy. You can see there we are a little bit more cautious in the first quarter, but we expect a rebound in the second quarter, and that trend continuing up to the third quarter and fourth quarter. We are basically advocating the fact that China is going to be a very interesting market, despite the noises that we're hearing in the property segment, as well as some of the big tech sectors that did last year. I think we're starting to sense as well now that monetary policy is going to ease. And I do think that this is a signal by the Chinese government to actually start to think about growth rather than controlling growth. And I'll discuss that a bit later. So that is basically how we look at two polars of the world. You always ask me a lot of questions about US versus China. I still think the China-US tensions will continue, but I think Chinese market going into the first half of this year is going to be a fairly interesting market to be in. But more importantly, before we get into the different opportunities again, I just want to set up the view and this whole big debate about inflation. Our base case is that despite inflation being high going into the first half of this year, we do think at some point in the second half of this year, especially in developed markets like US and Europe, will start to have more moderated inflation rates. Why are we so confident about this? Because the base impact, which is the base of year-on-year numbers, because the numbers have been starting to rise in the second half of 2021, will start to then moderate a little bit. The caveat to this view is that if the US continues to have higher inflation, then there will be no choice by the Federal Reserve to actually raise more than 3 times. But our base case is that they'll raise 3 times, and we do think that in the second half, inflation will start to moderate. What that really means from a stock market perspective is that despite all of what we are hearing in the, all the declines in the technology sector and so forth and all the other growth sectors, I do think at some point this year itself, particularly in the second quarter when the Federal Reserve starts to raise its rates and also start to indicate the tapering is over, I do think that people are going to price in a lot of these bad news, and it's really time to actually think about growth sectors and also developed markets as well. For the time being, I think the volatility will continue. Now, the other point is that why do we think that the moderation in inflation is going to come off in the second half? Effectively, what we have done is to analyze, for example, the Purchasing Managers Index, and that is starting to slow down a little bit already, especially in China as well as in the US. But more importantly, right, one of the biggest factors that has been driving global transportation rates or freight rates. Some of you in the audience are probably business people. You and I know at the end of the day, it's been a very challenging amount, especially if you're a manufacturer and you want to export your goods out there. Most of your margins have been crimped because of freight rates. And you can see the chart down here, right? Over the last year or year and a half, it's actually because of the pandemic, basically freight rates have gone down and gone up very, very substantially, right? But of late, you started to see most of the global freight rates. You can see there, the composite index down there in the middle down the blue line, basically starting to come off. I think if this trend continues, all of the bottlenecks that you're seeing in Port Klang or in China, Shanghai, and so forth, I think that will moderate. And then we will start to see some moderation in terms of inflation expectations. And hopefully that will basically normalize in terms of all the congestions and the supply constraints that we're seeing, right? So that is basically our view. Now, this is all other debate about the Fed Reserve. I've talked a bit about that. To me, right, I don't think we should be more worried about just because the interest rates are going up. Bloomberg has a very funny way of telling us all this bad news when bad news always happens, right? But, to put things in perspective, right, people forget, right, in 2020, particularly after the March sell-off when we just had the first lockdown, when all of us were staying at home, being very depressed, not knowing what the future was and so forth. I remember very, very vividly when, essentially the Federal Reserve went out there and they printed a lot of money. In fact, the Federal Reserve's interest rates went from 2% to almost 0% overnight, right? And so you can see the chart down here, right? About 1.5% all the way down to zero. What they're effectively doing now is basically when the economy is rebounding, they're basically trying to match interest rates higher. So I remember, talking to my parents and my relatives, and they all complain, you put your money in FD rates are so low. Then I told them this, the price of this is that when the interest rates are low, the value of your assets, especially risky assets, whether it's not property, right? Whether it's going to be a technology fund, whether it's going to be a growth fund, whether it's going to be a China fund, naturally goes up because basically, in theory, your cost of money goes up, your fair value goes higher, right? So when you start to have all of this tapering and all of these rate increases, people start to get a bit worried. And so that's where we are. We are going through a natural cycle of interest rates. The Federal Reserve is only going to raise rates by up to 0.75 this year, and maybe by next year to about 1%. That will bring the total interest rates up to where we were before, even lower, slightly lower than where we were before in March 2020. Now, essentially, when you think about the psychology of this, right, it's very interesting. Actually, late last year, we all knew that inflation was going to go up. Nobody actually believed that this whole inflation Federal Reserve thing was going to spook the markets. You come back to the new year, everywhere. So everybody's asking me, why is this suddenly happening? Well, it's all about expectations. Because the Federal Reserve, unfortunately, has been a bit late in telling the people that they wanted to raise rates. So it's about expectations. Now that they are telling the people that they're going to raise rates, I think at some point people are going to get used to it. People, being investors like us, right, are going to get used to this idea. And so when that happens, I think the volatility will come up a little bit. Now, the only real risk to this view is that if inflation numbers and the port congestions do not ease, and if wages in the US continue to rise, then of course, the Federal Reserve will then have to basically announce a faster rate of increase in rates. And that obviously will cause volatility. But for now, I don't think the Federal Reserve is really in a hurry to spook the market because the fact of the matter is, right, the Fed looks at the market, okay? It's just now releasing what we call the release valve in the market itself, to remove the froth. And I have another chart about technology a bit later, and I'll show you a bit later, right? But essentially, it's just removing the froth. It's similar to what the Chinese government was trying to do last year. It's just that the Chinese government is much smarter, right? They actually did it 1 year ahead of everything else because they knew that the Federal Reserve was going to raise rates. So they decided that, okay, you know what? I've got a lot of debt out there. I better basically remove the froth out there before anybody else. So they're letting some of the property companies like Evergrande go down and so forth. Now, guess what they're doing? They're now thinking about reducing rates. So I think it's going to be a very interesting environment where developed markets are going to raise rates in line with inflation, and certain markets in Asia, particularly in China, are going to reduce rates to support growth. And if you're a smart investor, you want to be able to buy into a market in the short term, at least short term means 3 to 6 months, into markets which are stimulative in the short term. And I think the Chinese government is right on track about that, right? So, and that is why I think the priority for the Chinese government, if you notice the language, especially in December, when most of us were, having a holiday in Langkawi or whatever it was, they were actually saying in the Central Economic Work Conference, the key word is now stability. When the Chinese government talks about that, right, you got to pay attention because the last time they talked about that was probably in 2016. If you recall, in 2016, they was having a lot of outflows and so forth, right? And then they went back to the drawing board and they basically told the rest of the people in the economy that, I actually want to have growth at a reasonable range. So I think this is going to be an interesting start of what the policymakers in China are going to focus on, which means going back to the drawing board, making sure that stability is back, making sure that growth will at least be growing at between 5 to 5.5%. Because don't forget, at the end of the day, when you have 1.4 or 1.35 billion people in China, you cannot afford to let growth go down too fast. And so I think Xi Jinping is well aware of it. He's already done the release valve stuff, which Fortunately, unfortunately, the Federal Reserve is doing it at the moment, right? So I suppose where I'm coming from is that the recent easing Chinese is signals to the market that they have moved away from tightening, which means removing liquidity from the market, to now supporting the market with some sense of a minor stimulus and so forth. Now, I'm not saying that the Chinese government is going to turn on the tap to actually release a hell of a lot of liquidity out there just because they want the property market to go up. I don't think that's the intention, right? If you read Chinese enough, they will basically say that, you know, when you buy a property in China, it's meant for you to live. So the problem in China today is that a lot of Chinese people out there have multiple properties and they speculate too much. So he's just basically taking the froth out of those kind of things and making sure that the growth trajectory of the economy continues to be stable. And you know, last year was all talking about this whole concept about inner circulation, making sure that they're more dependent on themselves in consumption and so forth, right? So I don't think that will change, right? But I do think that there is going to be some developments to support the growth. And I do think that every time they do that, markets start to pricing a little bit higher than where we are today. And that has been expressed early part of this week as well. When you saw the H-share market rebound by at least 3%, I think the markets are starting to put money back to work and rotate out of, for example, the US market in line with the divergence of the interest rates between the two countries. Now, we talk about US interest rates, we talk about tapering, we talk about China. I suppose the biggest billion-dollar question out there from your point of view is, where are the opportunities out there? Now, I'm not going to tell you how to invest, but I'm going to talk through this in terms of themes. And the way I think about this is that you need to basically think about your portfolios from a more diversified manner. And therefore, you would then, by diversifying those risks, you will then get more sustainable returns going into 2022. First and foremost, the big elephant in the room today, everybody talks about it. The US market is correcting. Technology, NASDAQ is correcting. Where do you put your money if you want to be in the US? I strongly believe the opportunity today is in the US small caps. And you can see down here, where the divergence of the PE is huge, where it trades about 15 times versus the US market about 20 to 22 times PE. And I do think that a lot of these small cap companies are also fairly resilient and also basically going to benefit, for example, from the US infrastructure plans, which the Biden administration is looking to support. And I heard early on about renewables in developed markets. These small cap companies also, some of these companies also have renewable sectors as well. And therefore will benefit from this whole ESG movement that's happening globally, especially in the US. The other thing I want to talk about as well is that the not very sexy topic today is about technology. And, you know, I was just doing some a quick update on the NASDAQ itself and how much it has risen over the last year and a half since March 23rd at the bottom of the market. Staggering numbers, right? The NASDAQ is up by about 132% at the bottom of the market in 2020. And anytime you invest between 2020 to 2021, you will make money. And you've seen that in our global tech fund as well, where you invested even last year itself, it was about up to 24%. Now, naturally speaking, when you go up so much, the market needs to find an excuse to basically correct. And that's where we are today. Now, a lot of clients have been asking me, what is going to be the difference between the tech bubble, inverted commas, today versus what happened 21 years ago, right, or 22 years ago in 2020. The big difference is that I do think that this time round, you got to be more discerning when you invest in technology, especially in global technology funds, whereby we segregate them by two categories. One, when you think about mega cap technology companies, whether it is the Apples, the Intels, and so forth, you know, which are basically very strong in terms of the balance sheets. They have very, very strong cash flows. You know, I personally have visited Apple before, and that was about 2 years ago. At that time itself, they were sitting, market cap was well less than $1 billion, and their cash holds was about 400 billion, right? Today, you fast forward, the market cap of Apple is close to about 1.3 trillion. Now it's corrected a little bit, but I think the cash flows are close to about a third as well. And that's about $1 trillion in terms of cash. So where do you want to invest? Obviously, you want to invest in the profitable mega cap techs. Now, there are also segments where, unfortunately, there are also a lot of technology companies which have risen because of, a lot of froth, as I call it, right? And so obviously these non-profitable technology index has been going down. In fact, it's been going down way ahead of the Nasdaq correction that we've seen this year. So I suppose where I'm coming from is that, unfortunately, people don't think too hard about technology, about profitable companies versus non-profitable companies. When you have volatility, as they say in our world, people throw out the baby with the bathwater, which means that people amalgamate the profitable companies with the non-profitable companies. At some point, and I do believe at some point, maybe in the second quarter of this year, when it coincides with the Federal Reserve raising its rates itself, I do think that the technology correction that we've seen today is going to set up itself for a lot of opportunities for customers like yourselves to start thinking about relooking into it. Because ultimately, what does that really mean? It really means that we are no longer 21 years ago buying into technology companies which are basically not going to be here for the next 20 years. I do think the profitable technology companies out there are going to be here to stay. Even the Teslas of this world, which don't really make that much money, is going to be here for a while, because I have another section about EV cars later on, right? And EV is going to be what I call the biggest beneficiary of the ESG movements that's happening. And I do think, and also because of climate change, but I also believe that technology is here to stay. You can't run away from it. You and I use our mobile phones. In fact, most of us talk to our mobile phones more than we talk to our family sometimes. So that's the reality of life, right? We need to be discerning about quality tech versus profitless tech. And that is how you're going to make money this year in technology. The other point, obviously, and obviously I'm a bit more biased in Asia itself, is the opportunity in Asia, right? And mainly because I see the big, huge valuation gap, especially in China and also emerging Asia as well, where I think the valuation is starting to be more attractive. And also it's also a home for a lot of technology companies and industrial companies, and also companies which I think are quality companies, particularly in the India digital economy, as well as some of the automation companies in China itself. So I think Asia is going to be a great opportunity if this correction continues, particularly in China as well as in India. And talking about China itself, our base case is that a lot of bad news has been priced in today. I do believe at the end of the day, these kind of pressures that we talk about in terms of all the controls on the technology sector there, and the mega caps and the property sector are behind us. I think you heard me talk about just now about the stimulus packages that's coming out from China. I think this is going to be setting itself up for the Chinese market to outperform, or even I would even postulate the idea to decouple away from the other equity markets across the world. And this is the chart that I talked about earlier on, the divergence about the market and economic policies. The US is tightening, China is going. You can debate all day long whether who is going to be right or wrong this time around. But ultimately, at the end of the day, if you believe the right-hand chart now here, where the Chinese economy is going to be reliant on itself even more, and they're going to build more and more of its global supply chains internally, rather than relying, for example, on the US, I think this economy is going to set up itself for a very interesting decade ahead of us, right? Yeah, I'll talk a little about China, and these are all the common questions, but essentially, I do believe the worst of regulation tightening is over. Property credit turmoil, I think we're starting to see basically some of the bonds in the property market start to rebound already. So I think that's a clear signal that for now, at least, the default rates in the Chinese property market is behind us. Nearer to home, you've heard me talk about digital boom in ASEAN itself. I don't repeat myself, but essentially, I'm a big bull on a lot of digital boom in ASEAN, where you can see all these bellwether names, whether it's Lazada, whether it's Shopee, and so forth. I do believe that ultimately, at the end of the day, the other guys who are going to benefit from this are the banking sector, which are now gearing up for digital banking revolution. And you start to hear, for example, our central bank, even in Malaysia, talking about issuing up to about 20 digital banking license, and most of the announcements are going to come out in the first quarter of this year. I do think that this is going to be a very exciting space to look out for, and they are going to be beneficiaries from this as well. Moving on, climate change, the previous speaker has spoken about this. I just want to spend a bit more time talking about the relevance of ESG, not just from a global perspective from this particular chart itself, And basically, obviously, I work for a European company, but obviously the Europeans are way ahead of this. And I think the previous speaker talked about, and there was a question about Asia, right? And I just want to talk about Asia's a revolution when I think about ESG, right? And this is a classic example of why I think climate change is changing one of the biggest polluters in the world, and that's China, to move the number of cars that they are selling on an annualized basis. Give you some numbers, right? 25 million people out there, essentially global EV sales, of a quarter of that basically going to EV. I do think that essentially this is going to set up sales for a lot of opportunities, particularly in ESG Asian funds. We have one coming on board soon, so if you're interested in that, let your salespeople know. I do think that this is going to be an exciting space to think about because we are in the early stages of ESG revolution in Asia itself. And I think the EV segment of the market could be one area that we want to be invested in. And of course, renewable energies, alternative fuels, battery producers, and so forth and all that, right? I'm probably going to be running out of time. So in conclusion itself, there's only three things I think you need to think about when you think about investments this year. I think the backdrop of the market is not going to be the same as what we've seen in the last 2 years, right? And I think the message that I want to send to all our investors out there is, number one, at the end of the day, know where your risk appetite is and be a risk aware going into 2022. I think you still can continue to be over equities and fixed income, but you need to moderate your risk appetite. Bigger and more global diversified is the way to go, I think. And therefore, that's why I gave you a lot of themes, that small cap in US, China and so forth. And I also think that if you're a little bit more, you want more exposure into developed markets, you got to think about quality growth. And of course, last but not least, this whole ESG theme is going to be here to stay. And I do think there are lots of opportunities, particularly in Asia for renewables, alternative fuels, as well as food sustainability. That's all from me. Thank you very much. And if we have enough time, I'm happy to take any questions and answers.
Hi, Patrick. Yes, thank you so much for your insightful sharing. It's indeed a very, very informative session. And we do have some questions flowing in. Okay, there's one question for you. China, India, and Indonesia are big markets right now. So what is the outlook of this market, as we have hear you mentioning that the China is all about stability, and also on the other side, China is having some regulatory concerns over the big tech giant and also property crisis such as Evergrande issue. So what's your view on this?
Yeah, so the first question, I think I've answered it already, right? I do for now, the worst of the regulatory tightening, it could be behind us. From our perspective, I do see that I think the Chinese authorities are backing a little bit, although I don't think that they actually want all of these big tech companies to overwhelm the landscape of the corporate world in China. I think that's key point number one. I think when you think about it from a Xi Jinping point of view, a very more stable, more inner circulation kind of world, you want to be able to be, how would I say it? You want to share the prosperity across the people, and that's where I think the essence of the regulatory tightening coming from China. Now, I think the other question from you within that question itself is what was that again?
Just a moment.
On Chinese property, right?
Yes, is the threats over the
I suppose we are in that environment today where the interesting part is my theory about China today, which is interesting and is countercyclical, right? Is that like I said earlier on, right? They were willing to experiment with the release valve theory. The release valve theory is that there was so much excess leverage into the property market, and people. For the longest time I've been to China, people have been talking about this for more than a decade. They realized that enough is enough. In fact, they already started doing this about 2 to 3 years ago, but they accelerated this. And you got to ask yourself, why on earth did they want to accelerate this, especially in 2021, when the economy was still fairly buoyant? My simple answer to that was that because they could. It's a command economy. They're willing to do that because they believe that, why not take the release valve off now? When the economy is, you don't want to do it when the economy is actually deteriorating, right? And so I think they've done that. The economy actually has decelerated consumption decelerated, property sales have decelerated, and then some property developers have gone under. They're willing to let them go under. But that's interesting to me, right? Because to me, the Chinese government also knows that the property sector is the largest wealth impact for a lot of Chinese consumers out there. And so you want to release it, but you also don't want to kill the golden goose, right? So now that I think this credit turmoil that we're seeing today is starting to now come off, especially when you're releasing liquidity, you have RR cuts and so forth. It's a signal to me that, okay, guys, enough is enough. I've taught you a lesson. The risk, let's move on. And the stability of the economy is a priority today.
Right, thank you so much for your answers. And moving on, as second question, that will be our last question of the day. So what's your take over the US mega tech versus the mid or small cap tech stock potential going into the next 12 months?
Honestly speaking, I do think, I think we are in an environment where I think the mega caps are essentially going to go through a minor correction in the bull market. And I think that's a healthy sign. At some point, whether they're going to be small cap technology companies or mega cap companies, which I think are quality companies, I think both of these segments of the market are going to be a favorable environment to be in. Unfortunately, at the end of the day, with the cost of money rising, a lot of growth companies suffer in the short term, but I don't think it's going to last forever. So I think at some point this year itself, you will set yourself up for an opportunity for clients to buy into this. And if you look at some of our global tech companies today, these are the companies which we are in, and I don't think we are in any way close to those kind of speculative tech that people have invested in. I don't want to mention what other funds out there, but essentially, we're going to try to avoid that in our portfolios.
All right, thank you so much, Mr. Patrick. So the time is already up. Thank you so much for your insightful sharings today, and a lot of investors giving a very good feedback over your presenting today. Yeah, thank you so much, Mr. Patrick, and we hope that you join our next event ahead. Yeah.
Yes, thank you so very much. And wishing all the Chinese investors of ours a happy Gong Xi Fa Cai and the Year of the Tiger. I'm a big believer that Tiger Year is going to be a very interesting year. So hopefully we shall continue to grow and invest together. Thank you.
Thank you so much, Mr. Patrick, and happy Chinese New Year to you too.
Yeah, thank you. Bye.